In the year 2000, if you asked an American where to invest their savings, many of them would say the same name, Enron. It was the seventh largest company in the United States. Its executives appeared on the covers of business magazines. Its stock was in millions of retirement accounts. Ordinary people's futures, teachers, nurses, factory workers, all betting on one company. Then, in the space of 24 hours, it was gone. Not struggling, not in trouble, gone. This is the story of how that happened, and what it tells us about the language of modern business. If you're new here, welcome. Deal English is where you learn the language of business through the real stories behind the world's biggest companies, deals, and collapses. Subscribe before we begin, and stay until the end, because every video closes with the vocabulary that will make you sound like you belong in any boardroom in the world. To understand why Enron's collapse was so shocking, you first need to understand how impressive it looked from the outside. Enron was founded in 1985 in Houston, Texas, as a natural gas pipeline company. Simple enough, but by the late 1990s, its CEO, Jeff Skilling, had transformed it into something far more ambitious: an energy trading company. Instead of just moving gas through pipes, Enron was buying and selling energy contracts, essentially making bets on the future price of electricity and gas. And on paper, at least, it was extraordinarily good at it. By 2000, Enron reported revenues of nearly $100 billion. It employed 20,000 people. Fortune magazine named it America's most innovative company for 6 consecutive years. Wall Street loved it. Analysts told their clients to buy, buy, buy. The board of directors, the group of senior executives and outside members elected to oversee a company on behalf of its shareholders, publicly praised management. They said Enron was a model for the new economy. But there was a problem. Almost none of it was real. To understand how Enron fooled the world for so long, you need to understand one concept: mark-to-market accounting. Mark-to-market is a method of recording the value of an asset based not on what you paid for it, but on what it's currently worth, or in Enron's case, what it might be worth in the future. In traditional accounting, a company records a profit when it actually receives money. Mark-to-market allowed Enron to record a profit the moment it signed a contract, even if that contract wouldn't pay out for 10, 15, 20 years. Enron pushed hard to get regulators to approve this method for energy trading, and in 1992, they succeeded. Here's why that mattered so much. Imagine Enron signs a deal today to supply electricity to a city for the next 20 years. Under mark-to-market rules, Enron could estimate the total value of that contract, say $500 million, and book the entire amount as revenue right now in this year's financial reports. If the contract later turned out to be worth far less, that was a problem for the future. Today's numbers looked extraordinary. And so Enron's accountants got to work, projecting enormous future profits and recording them as present income. The reported revenues climbed. The stock price climbed with them. But here's where a lie, once started, becomes very hard to stop. Because every year, Enron needed its numbers to look better than the year before. To do that, it needed bigger and bigger contracts, more and more optimistic projections. And when real business couldn't keep up with the fantasy on paper, Enron's executives found another tool: shell companies. A shell company is a legally registered business that exists on paper but has no real operations, no products, no employees, no genuine commercial activity. It exists purely to move money around, often to hide where that money is really going. Enron created hundreds of them, giving them names like Raptor and Chuko. Yes, after Star Wars characters. These shell companies allowed Enron to transfer failing assets off its own balance sheet, hiding enormous losses from investors and the public. The result was a company that looked, from the outside, like a $70 billion success story. On the inside, it was rotten. But someone knew. Her name was Sherron Watkins. In August 2001, Watkins was a vice president at Enron. She had spent years working inside the company's finance division, and by mid-2001, she had seen enough to be deeply alarmed. She did something that required enormous courage. She wrote a memo directly to Enron's chairman, Ken Lay. A whistleblower is someone who exposes illegal or unethical behavior within an organization, usually at great personal risk. Watkins told Lay, plainly and in writing, that Enron's accounting was fraudulent, that the shell companies were hiding catastrophic losses, that if the truth came out, and she believed it would, the company would collapse. Lay received the memo. He passed it to the company's lawyers. The lawyers, who also worked for Enron's auditing firm, a serious conflict of interest, recommended no major action. An auditor, or auditing firm, is an independent body that examines a company's financial records to verify they are accurate and honestly reported. The key word is independent. Enron's auditor was Arthur Andersen, one of the 5 most prestigious accounting firms in the world. They had been approving Enron's accounts for years. What Watkins's memo revealed, and what investigators would later confirm, was that Arthur Andersen had known about the problems and looked the other way. Some of their employees had even shredded documents when regulators began asking questions. The auditors had failed completely. Meanwhile, Enron's executives were quietly selling their own shares in the company, even as they publicly told employees and investors to hold on, that everything was fine. It wasn't. In October 2001, Enron announced a $618 million loss for the third quarter of the year. It also disclosed, meaning it officially revealed to the public for the first time, a $1.2 billion reduction in shareholder equity. Disclosure is the legal requirement for companies to share material information, anything that could affect an investor's decision, honestly and in a timely way. Enron had been violating this principle for years. The market reacted immediately. Enron's stock, which had traded at over $90 per share just a year earlier, began to fall, then fall faster. The Securities and Exchange Commission, America's financial regulator, opened a formal investigation. Banks began to distance themselves. Business partners began to pull out. Then came the word that ends companies. In December 2001, Enron filed for bankruptcy. Bankruptcy is the legal process through which a company or individual that cannot pay its debts seeks protection, either to restructure and try to survive, or to close down and sell its remaining assets to repay creditors. Enron's bankruptcy was, at the time, the largest in American history. 20,000 employees lost their jobs. Many of them had held their retirement savings in Enron stock because the company had encouraged, sometimes pressured, them to do so. Those savings were now worthless. The liability, the legal and financial responsibility for the harm caused, fell hardest not on the executives who had constructed the fraud, but on the ordinary people who had trusted them. Ken Lay was convicted of fraud. He died before sentencing. Jeff Skilling was sentenced to over 20 years in prison. Arthur Andersen, one of the world's most respected accounting firms, was convicted of obstruction of justice. Within a year, it had ceased to exist. The Enron scandal didn't just destroy one company. It shook the foundations of how corporate America operated. In 2002, the United States Congress passed the Sarbanes-Oxley Act, often called SOX, a sweeping package of financial regulations designed to prevent another Enron. The law made CEOs and CFOs personally certify the accuracy of their company's financial statements. If those statements were fraudulent, executives could face criminal charges. It created strict new rules around auditor independence. The same firm could no longer provide both auditing and consulting services to the same company. And it created stronger protections for whistleblowers, the people brave enough to report wrongdoing from inside an organization. The board of directors, previously in many companies, a rubber stamp body that rarely challenged management, was now legally required to include independent members and to take its oversight role seriously. Sarbanes-Oxley didn't make fraud impossible, but it changed the language and the rules of corporate accountability forever. The words you've learned today, audit, disclosure, liability, whistleblower, became central to how regulators, journalists, and investors talk about the health of companies. Every major financial scandal since Enron has been measured against it. Because when a company that employed 20,000 people, that held the retirement savings of millions, that called itself America's most innovative company, when that company turns out to be a $100 billion lie? The world pays attention. Before you go, let's lock in the 8 business English terms from today's story. Audit, an independent examination of a company's financial records to verify they are accurate and honest. Bankruptcy, the legal process through which a person or company that cannot pay its debts seeks formal protection and either restructures or closes down. Shell company, a legally registered business with no real operations, used to move money around, often to conceal losses or avoid tax. Whistleblower, a person who reports illegal or unethical behavior inside an organization, usually at significant personal risk. Mark-to-market, an accounting method that records the estimated future value of an asset as income today, rather than waiting until money is actually received. Board of Directors, the group of senior leaders and independent members elected to govern a company and protect the interests of its shareholders. Liability, legal or financial responsibility for harm, loss, or debt caused to others. Disclosure, the legal requirement for companies to share material information, anything relevant to investors, honestly and on time. That's episode 2 of Deal English. If you understood 80% of this video, your business English is at a solid B2 level. If you understood everything, including why mark-to-market was dangerous, not just what it means, you're working at C1. Either way, you're exactly where you need to be. See you in episode 3.